Hello and welcome to VHGV, your guide to the talent, culture, and capital forces shaping the hard tech startup ecosystem. My name is Brian Major, COO and CTO of Ad Astra Talent Advisors. At Ad Astra, we work closely with founders building hard tech startups across space, climate, and defense. Our focus is helping these companies hire the executives and technical leaders who can turn bold ideas into functioning systems. And because talent decisions shape the trajectory of these companies, we also spend a lot of time helping founders think clearly about how those teams scale and how leadership evolves as a company grows. I'm joined by Matt Jurtson of Built. How you doing, Matt?
Doing great, Brian. I'm really excited for the chat. I know what we're talking about, and I'm excited.
It's gonna be a good one. And Justus Killian of Space Capital. How are we doing today,
Hey,
Justice?
what's up, Brian? Good to see you.
Awesome. So today we want to kind of pull on a kind of an opposite thread of one we've touched on recently, um, where if the one of the other topics was if you have all these resources, like um, how do you need to consider slowing down, be using that scarcity to like become more creative and being disciplined. But today I want to touch on the topic of, well, what does the other side of that look like? What does it look like to move too slowly, or what does it look like to have too much discipline, where you're too constrictive with resources, and how can that impact the growth and evolution of your company? So I'll start by just putting that out there. Matt, Justice, what are some of the first things that show up for you in your work if you see a founder, or some leaders who are maybe a little tight knuckled on their bank account or on their hiring plan or anything like that?
For me, the first thing that comes to mind is my experience in the military, honestly, and how much what it does to your culture if you are too slow or too hesitant to make decisions. And I think, in the military, a lot of this comes back to this idea of like how quickly things are changing and how static the world is. And in a unchanging world, you don't need to make decisions quickly, and it's better to just wait and make sure you're not making the wrong decision. Versus when things are changing really quickly, it's better to just act and not wait. And from a culture perspective, having been in it, I can say that when you have an incredibly risk averse culture that moves really slowly, the people who are innovative, the people who want to go do things, the people who want to make a difference, they just leave. They go somewhere else. And so there's this balance where I think when you are too disciplined, it can set a precedent that causes people to just go elsewhere where they can start to make a difference. That's at least the first thing that comes to mind for me.
I mean that was really interesting, and I love the idea of taking your period in service and seeing like one very large organization that is responding and adapting to a very real changing environment, but then the training and the preparation that individuals have, like in environment, like when they're deployed, things are changing incredibly rapidly, and you have to have the skills to be able to dynamically respond, and you can't just sit back. So that's incredible. That was a really interesting thread to sort of pull on. When we started, framing this out, the thing that came to mind, based on sort of my experience investing, is a cultural difference that I've seen really between the United States, which is much more sort of risk tolerant when it comes to building startups. And
Hmm.
in that world, you're willing to, take big bets, spend a lot of money, sort of chase the market, in some cases, subsidize the market to help grow and try to build and create a company. And so that was really where our previous conversation was at. Um, we have also actively invested across, Europe and Asia, um, and working closely with founders in those markets, I have seen a fundamentally different culture of risk where bringing in, millions of dollars into the company, the mindset is actually like, okay, now we have this, protection, and we need to, um, almost like hoard it, right? It's our backstop. And as opposed to deploying it to go and sort of take on and climb the mountain and get to the next milestone, it's like, okay, now we actually have a buffer, and let's save this and only use it in like the most dire situations. And so, you know, part of the work that I've had is like even in screening, founders, is like trying to understand how they evaluate risk, and like if they say they're gonna, go hire three, four, five people, are they actually gonna go put that money to work? And um what is their sort of personal view on and tolerance of risk, and how do they respond in that environment? And I've had to work with founders to help sort of push in the direction of spending that money as opposed to just sitting on it and like preserving the life of the company, but like foregoing the opportunity to chase the market and build the company that you want to build.
Yeah, I think this is really good, and I also liked, Matt, what you were speaking to of like you're trying you often need to make decisions at like the pace of change of the environment you're in.
Yeah.
And
Yeah.
so I think that's a really good example of like how to think about this, because if you're in some sort of environment that's very, very static, it might be more important to make sure you're pointing in the right direction, even if you're not going as fast. But then there's other cases where the industry is moving and changing so fast that like just making sure you're pointed roughly correct is good enough, and then you just need to sprint and like be reactive and responsive to what it's telling you. And I think there's also like a big difference from my perspective of like you can be deliberate and disciplined while not being overly restrictive or just like putting in red
Sure.
tape just to like put in red tape. And so I think, what hires are you making, and what is the culture of those hires? Are they there to ultimately help people be disciplined and make good decisions? Um, or are they there to just like restrict, 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 create problem like challenges and restrict growth. Definitely not everyone's like this, but like there's examples of like legal and HR and CFOs that where like you can either be in that company to create discipline and protection and help the company ultimately go further, or some people can get in those seats and just try to like tighten the purse strings and like overprotect on risk, and then nothing gets done. And so that's like a very delicate balance, and like how you hire for those roles I think can have a really big impact on if you're being disciplined or just overly risk averse.
This brings up an interesting point that I think is often overlooked by founders. Uh, I talked to a number of really capable individuals that are, looking to start out a company, and they're, coming to me as a venture capitalist because they know that like, you put a couple $1 million in and you're trying to build a company, but they don't a lot of founders don't understand that there are different sort of flavors of money, and with those different flavors of money come different profiles of risk and expectations. And so like
Mm.
Interesting.
I think what's interesting to, sort of align here, like venture capital is the highest risk and highest risk tolerant capital. The
Hmm.
expectation is that you are going to quickly put that money to work and rapidly chase the biggest, boldest opportunities that you can. And the opposite of that, like sitting on that money and just waiting and observing, is sort of the sin in that case, right? And so there's a very misaligned set of expectations if you raise venture capital funding and your intent is just to sort of slowly build with the market, right? If that is your intent as a founder, there are different flavors of money that are better aligned with you, right? And so private equity, private credit, is sort of another option that takes a slightly different approach. You're going to have more constraints around the capital, the expectations, the controls that are going to be given to you with that money are going to be way greater. But it's going to be directed very intentionally at a handful of activities that you've defined. When you get on the debt side with it, whether it be private credit or even a bank, you can only use that money for what you've said you're going to use. And in the case that the company can't pay it back, they're going to take, your assets and get their money back. And so, with high risk comes freedom to like go do the thing that you
Mm,
want in any like undefined way, and the expectation that you'll move so quickly and diligently. But, with constraints, you can now have more capital, but less freedom, and, sort of a more intentional, clear pathway of growth. And so those are the trade-offs that you sort of make. And it's important as a founder to align with like the right type of risk profile that your business and your personality, are taking on. The other way
yeah.
that this shows up is like the venture hamster wheel, or the venture treadmill. Like a lot of founders don't realize that like you're raising a round, you're going to spend that money, you're going to go raise another round, you're going to spend that money, and it's just like this perpetual cycle to hopefully get to a 5, 10, $20 billion company, and then you sell it, you exit, right? If that's not what you're trying to do, you're just trying to build a good company and slowly incrementally grow your margins, like that's just not venture capital. There's other
Yeah.
money to do that. So
Yeah.
Yeah. And I think tying to that topic, like there might be a stronger case for that slower, more deliberate approach if you're already profitable, you already have product market fit, and then you're now like feeling your active customer base and like what's already working, and then the risks and mistakes are maybe a little higher, right? Because you've already gotten to that, maybe not mountaintop, but like version of that. And so then you might be more sensitive to dilution and not as interested in growing fast. But if you're not at that stage yet and you're receiving venture capital, I think that like is a good use case for like the money wants you to be risky.
yeah.
So it's really fascinating.
Venture's predicated on growth. That scenario you're talking about, like you're the master of your own domain, right? Like you have,
Yeah.
your own money that you're making, and you choose without any constraints what to do with it, right? That's the best case scenario for many, many
Yep.
founders. Like just build a great business.
Yeah.
Well, and I think some of at least the way I would think about, am I in a situation where I should do one versus the other, or what's the difference between spending too quickly versus too slowly? To me, so much of this comes down to how clearly you have identified the question you're trying to answer, and how much capital it takes and time it takes to answer that question.
Mm.
If you have a relatively small question that can be answered quickly, then like you need to go after it. Then you should go after it really quickly, and maybe you can do that without any outside capital. But I think that's at least where I would assume you draw the line between too fast and too slow of putting out resources. Is I don't really know what the question that I need to ask is, and I'm just hoping that if I hire enough people or spend enough money, then I'll find it. Versus I very clearly like, here's the question. I mean, that's always been my favorite example of how to think about funding rounds, is like you should be saying like, this is the question that I'm going to answer with your money.
Yeah.
And this is
Yeah.
and once we answer that question, because we know that answer, we will be now worth this much money, and this is the question that we're going to answer with the next round. But it's how clearly and coming back to the hiring piece, some companies that I've seen that are able to have lots of freedom in their hiring and hire very quickly is because they spend all the time up front writing clear job recs, where it's like, we know why we are hiring this person, what they are going to be doing. And so then the hiring managers are given a little bit more freedom to just like, okay, go get them. Versus if that early stuff is murky, well, then maybe the founder wants to hold on to it a little bit more and be the final sign off. And you add all these layers because you haven't clearly identified the problem that you're solving.
Yeah. I mean, we've definitely been with a lot of companies that are all over the place with what their hiring needs are. They change like with the direction of the wind, and it's pretty wild. And so I think there are definitely cases in hiring in particular where some amount of discipline and slowing down is really worthwhile, because the more clear you are on what you need, who you need, what they're going to be doing, the less likely you're going to be just chasing a bunch of things that you never actually needed in the first place, or that you never actually received any value from. And so I do think hiring is a good place to realize the lead time typically for actually getting someone in the seat, and let alone the time that they actually start delivering value, is long enough that you need to, like, take a breath and,
Yeah.
like, look at what you actually need and make a deliberate decision and factoring that all in because, 6 months is a pretty realistic timeline from, like, "I'm gonna start this search," to, like, "I'm gonna receive any value from that
Yeah.
search," and so much can happen in 6 months, and so I think that's a really important case.
There is
Matt. Oh, yeah, please,
I
Justice.
wanted to pull something together because we've all three just touched on the importance of this single word, which is clarity.
Yeah.
Oftentimes, founders and companies don't really have clarity on like what they're trying to do, and like it's really hard to align your capital, your leadership, your recruiting around that. And it's okay to not like know the answer to the problem that you're trying to solve, but you're putting that hypothesis out there, you're putting money and people and resources to go and find that answer, right? And
Yes.
test that hypothesis and then learn from it, and that points you then in a new direction. But oftentimes you get competing priorities or competing trajectories and therefore a lack of clarity. And so it's really hard to then hire or set a strategic direction or bring on the right types of capital that are aligned, to that. So that to me just really stood out. We've all like really sort of anchored on this idea of clarity and what it means.
Yeah, and I couldn't double stomp or foot stomp more what you just said. That piece of that, it doesn't mean clarity of like, I know what the answer is.
Yeah.
It's clarity of I know what I'm trying to figure out.
Yep.
Yeah.
So good. Awesome. Well, this is a really fun conversation diving into what it might look like for companies to move a little too slowly, what too much discipline or just inaction might look like, and what some of those risks are. And we covered like the realities of different environments move at different paces, and so that might dictate that your decision making might be a symptom or product of your environment. Also talked about how there's just different types of investments in different stages of companies where more risk is maybe not only tolerated but expected, like in venture, or specifically it's not a good idea to be super risky. Maybe you're profitable, you have other types of funds where the your investors would not be accepting of good risk. And so I think there's some really key pieces here to focus on when you're thinking about speed and discipline. And I think a lot of it comes down to what we just touched on in the end. What Justice highlighted is like the clarity of knowing the problem that you're trying to solve. And if you have clarity on that and generally like alignment within your organization, then now you can go get the appropriate funds and the people to go answer or solve the problem. And that will hopefully prevent you from too much inaction or overaction. So
Hmm.
thanks for the conversation, you guys. Really, really enjoyed this one.